Hi, today I'm going to talk about the Lululemon stock valuation. For those who are not familiar with Lululemon, Lululemon is the top one yoga pants apparel company. Before we talk about the company, I would like to talk about a little bit about the male and female clothes. And in this video, I will explain why I'm interested in the Lululemon stock, how do I analyze and reach the estimated price for the Lululemon stock, and whether to decide to buy or sell the stock at this moment. In this graph, it showcases several different clothes male and female wear. And if you take a look at these clothes, you can find that there's always a conflict between being comfortable and being stylish. So if you take a look at these clothes, for example, for male, if you want to wear properly, you can wear things like suit, leather shoes, and for female, you can wear dress, high heel. But these clothes are not very flexible, and it's hard to make movement or take actions. In contrast, clothes like running shoes and also like jeans, like shorts, there's probably no shorts here, shorts and skirt for female, they are easy to make movement. They are easy for you to feel comfortable. However, it's probably not that appropriate for some occasion. So there are always some conflicts between being comfortable and being cool. But there's some clothes did find a good balance. One thing is running shoes. If you think about Nike or Adidas shoes, they are created or designed for professional athletes. However, right now people wear them for daily life, and it's also okay for them to wear in some occasion that not seriously. And I believe that yoga pants has the potential to become or is becoming this type of clothes for Generation Z. Not until the 2026, I barely knew about yoga pants. Before that time, I mostly lived in Asian countries like Japan, Taiwan, Hong Kong, China, Thailand, etc. And I cannot recall a time that I saw female wearing those clothes. Not until the 2016, when I was studying US, I saw that yoga pants are all over the campus. To show how little I know about yoga pants, I cannot even differentiate yoga pants from things like leggings, stockings, even nylons. But right now, I have knowledge and even experience, not personally, but I have experience about that. So I know about yoga pants, and I saw that people in North America, in US, they wear them all over the place. They can wear that to take a class and even go to the meeting, go to the party. That's why I'm interested in this kind of clothes and immersed in it. But I don't know about Lululemon until 2021. In 2021, I moved from US to Canada. My friend just drove me to my place on Robson Street in Vancouver. That is one of the most crowded and populous place in Vancouver. Some people say it's most terrible place in some sense. But she was showcasing different store and things on the Robson Street and told me that is Lululemon is selling yoga pants. I asked her, is that good? She said, well, many people like it, but it's kind of expensive. I said, oh, it's cool. However, what is in my mind is this is a company in a traditionally low profit margin industry apparel. However, it has the potential to achieve high growth and profit due to its branding and customer loyalty. I know it sounds pretty sick, but that is investor mindset. But I'm not in rush to buy the stock at that moment because that is 2021. The stock is at record high because most people are stay at home due to the COVID and they need to work out or do yoga at home. So there are many people buy it. But about 1 year ago, I saw from news that Lululemon stock has reached the 5 years record low. And I think this is a moment I want to research and analyze about the company because if you want to make money from stock, you will want to buy when everyone is sell, and you will find opportunity to sell when everyone is buy, not opposite. And that's why about 1 year ago, I finished my first evaluation for Lululemon and I post my estimate on social media. Because being in this industry, I have saw so many analysts on CNBC, they like to make claims, but they barely take responsibility for that. Many times they will say this stock will go skyrocketed or this company is dying. However, after 1 year or after a while, if the stock price goes the opposite, They never admit their mistakes. And I think that is not very good, and I don't want to be like that. So about 1 year ago, I made this claim. I estimate the company stock is about 245 to 286. If you check my personal website, you can also see that I wrote analyst on April 17th. And this graph shows what the price has been changed. So you can see that after I analyze, the stock decreased from about over 350 to about 250, and it jumped back to 400. However, after the company's most recent quarterly report, the stock decreased to 222. Although the earning beat the analyst estimation, but the stock still decreased to record low. So in this video, I will explain how do I estimate value per share, whether to buy. I will also explain why the stocks keep decreasing. When you buy a stock, you are owning a piece of the company. For example, if the company issue 1 million shares and you own one share, so you are owning the 1 million of the company. However, you get paid by several parties afterwards. So the company first they will pay their supplier to produce the product, and if they borrow money, they need to pay their borrower first. They probably also have some pension funds for their employees. They maybe also need to pay some legal lawsuit if they have that. So after they pay everyone else, if the company still have money left, that is the money owned by the stockholder. So if the company's future growth after this payment is higher than the current stock price, that's how you make money. To estimate the company future growth, how much sale they can make in the future, there are many two ways. First is a method used by investment banker, analysts, mutual fund, Wall Street analysts. Those they either check the company's historical data. So for Lululemon, they probably say how much revenue growth they have in the past 10 years. Another thing, they will check the industry average. So Lululemon is a apparel company. They probably collect information about hundreds of apparel companies to check their industry average to use that growth rate for Lululemon. But there are several drawbacks for this method. First, what happened in the past does not predict the future. If you check many most successful companies in history, like Cisco, Intel, they have very high growth during the dot-com boom. However, as time passes by, they cannot replicate their growth and their stock will decrease. The second drawback is that by using the industry average, you may overestimate declining company or you will miss some star company, some exception. One example is Tesla. If you see Tesla stock price, the stock price has been so volatile. One of the reasons is many analysts in the early time they use the vehicle industry average to estimate Tesla. So when they use the vehicle industry average, they will use company like Volkswagen, Ford, Toyota, etc. But electrical car business is a different technology. It will require different reinvestment. It can charge people in different price. So when they use the traditional vehicle company, they miss out many potential growth that Tesla will. So that's why the price has been up and down so much. I personally think Tesla stock is overvalued at this moment, but that's another story. The second way is what I call the internal revenue growth. Is you focus on the company. You see how the company make growth. Suppose you invest the theme park. You have many games and you make money by selling the tickets, by selling food, by selling like food toys in the theme park, like Disney. But if you want to keep growing business, if you want to keep selling tickets, you need to remodel or you need to maintain the equipment. If you don't maintain the equipment, those equipment will be worn down. And if you do not change games, people also will get bored easily. To estimate the company's future growth, you need to focus on how much money the company will put back in the business, which is called reinvestment rate. Another thing is how well they can get a return. Say if you invest in 1 million and you get a half million return, that is 50% return on capital. So these are two things that if you want to calculate internal growth. However, for the Lululemon, I will like to use the first method, the industry average. Why? Because there are two types of company. One company they can create the demand, like Apple, NVIDIA. If you think about the Siri function in Apple or Apple Watch, customer didn't come up with those design, those demand at first, but Apple create this demand to make customer want to buy. Well, another type of business is to meet customer demand, like apparel. They want to meet the customer demand to see what the customer want. And usually, by common sense, if you wear jeans today, you are unlikely to wear yoga pants today at the same time. People will have limited number of jeans or other clothes, but of course, female will have more. So what I do is I will first to check the number about the top 10 most successful sportswear company. Well, I don't think Lululemon can replicate all of them. I have some ballpark about Lululemon's future growth. You can see that this is the data from Statistica. It shows the top 10 sportswear company ranked by revenue. Here we have the most well-known company, Nike, Adidas, Puma. And you can see that Lululemon, as a young company, has achieved a comparatively high revenue growth at the number 4. And we also have Under Armour, Li-Ning, etc. But when I see this data, I found some challenge. The thing is like for sportswear companies, their revenues are very volatile. It's very sensitive to different factors like the temperature, the seasonality, and also even the specific type of brand. For example, if this year is colder than usual, probably you can say that Columbia sportswear will have much high growth because people like to wear their coat. Because if you have one type of successful product like Air Jordan, many people will buy that, but that 1 year success is not replicable. So how do I reduce the volatility in this data? I calculate what I call the 10-year revenue growth. So what I do is, like for example, for Nike, I can see how much revenue they grow from 2000 to 2009, from 2001 to 2010, from 2002 to 2011. I did that until the 2014 to 2023. And I do that for each of the 10 companies. After doing that, I have 10 years for 10 brands, so I have 100 data. What is good about this data set is that means that if I pick a random 10 year from a random company on the top 10, I can know how much revenue they can grow in the 10 years. Doing so, I reduce the volatility from 1 year temperature, fashion trend, etc. And this is the data I got. I know you probably looks kind of, not familiar, but I can explain to you. So this is a distribution, and here we have the average for 182. That means that for this 10 company, averagely they can grow 182% revenue in 10 years. But here you can also see there's a something called standard deviation. To understand, you need a little bit statistical knowledge, and that is very important for the stocks. And I will explain that. These are data made by myself for two countries. We have country A and country B. So first, the country B has a higher average income than country A. However, here I show their income by different age group. If I just tell you that country B has higher than country A, and I ask you which country you want to work, probably your first reaction is you want to work in country B. However, if I show you this distribution, I think you will change your mind. Because if you see, although country A has lower average income, by working in country A, you can gradually increase your income. In contrast, in country B, most of people make most of money after 40 or 50, which means you will have a hard time to accumulate your wealth during the young age. So this is the significance of standard deviation. Standard deviation means how different each data in the sample is from the average. And the higher the standard deviation, the more volatile it is. As you can see that this data has a very high standard deviation, but it's okay. I don't have to get a specific number for the stock price. I can get a distribution. Just need to buy the stocks when the most data are centered. So here we have the data from the New York University Stern Business School. It has data set from hundreds of companies in different industry. And there are many terminology here you probably don't understand, but just bear with me. This is the revenue growth for the next year. You can see that the median number is about 8%. Here you will see first quartile and third quartile. The first quartile means one standard deviation lower than the median, and the third quartile means one standard deviation higher than the median. When you value a company, if you want to decide which number to use, you need to make your judgment about the company. Whether your company is a mediocre company, whether your company is a declining company, or whether your company is a company better than average. For Lululemon, I think it's better than average. That's why I start with the 200.50%. Here you can also see the operating margin. Operating margin means for each dollar of sale, how much money you can make. If you sell a clothes for 100 and you make $20, then the operating margin is 24.71%. For Lululemon, at the beginning, I just start with the 20.50%, and I gradually decrease to the 4.0.8%. Why do I do that, and how do I get those numbers? So just like human, we're born, we grow up, we matured, and we're aging, and finally we die. Company did the same. They will have high growth as they grow up, but as time passes by, they will gradually decline. And how do I get this 4%? The 4% is US 10 years government bond rate. And if you read my previous article on my website, you can know that the 10-year US government bond is comparatively equal to the long-term GDP growth rate plus the inflation rate. You can check my website for that. So what I do is like I give the company 5-year high growth, and then I gradually decrease to 4.8%. If I'm doing so, the 10-year revenue growth will about 300% at at this point. And here, I know there's many numbers, but just bear with me. Here I just try different revenue growth so that the 10-year revenue growth will reach to this distribution. And after doing that, I can reach different price. Lululemon right now doesn't have any debt. But that doesn't mean that the company will not have debt in the future. So I collect those successful sportswear company, and I use how much debt they borrow divided it by how much asset they have, so that I get the debt ratio. And you can see that it will range from 0 to about 30%. So I say that if Lululemon borrowed this different ratio of debt in the future, how much the value of the stock can change. And I got those values and I got the median. The median price before other adjustment is $284.57. Just about several months after I did the valuation, Lululemon announced to borrow money through the Goldman Sachs. After you estimate this revenue and earnings, there are still many other different activities that can affect the company value. And in the next part, I will explain this activity like acquisition, like market spending, etc., and explain how they affect Lululemon. And I will also explain in the second part why the stock has decreased to 220 and whether to buy or sell the stock in the next part. So just check it out.